Good afternoon, ladies and gentlemen. I would like to welcome you. It turns out that our results are not as surprising as the number of people who decided to come to our meeting. Ladies and gentlemen, it's time to summarize the third quarter, and traditionally, our situation, our plans for the end of the year and the next year will be presented by Mr. Przemysław Lutkiewicz, and I will tell you about interesting events in our company. I will say a few words about interesting events that you haven't heard during our Investors' Day. And now I give the floor to Mr. Przemysław Lutkiewicz. Good afternoon, ladies and gentlemen. Welcome. We have seen each other recently during Investors' Days in Gdańsk. Well, the time flies, and I'm here in Warsaw presenting you the results after the third quarter of 2015. Let's start with a big picture. At the end of the year, we had 1,574 stores operating in 17 countries. LFLs in local currencies was comparable to the previous year. However, the floor space grew 17% year-on-year. Hence, we had 3.5 billion zloty in revenues. So the margin was under pressure of the growing value of US dollar. So we were working very hard on our cost, and we were able to reach negative 16% in SG&A per square meter. So after 3 quarters of 2015, we had 267 million in EBIT. Interesting news after the third quarter. So we continued to open new stores in Czech Republic and Slovakia, and here I mean Prague and Brno and Czech Republic and Trnava in Slovakia. An interesting fact, it may seem that Czech Republic and Slovakia represent the same type of customers. In the past, it was just one country, but it turns out that it's not true. The Slovakians buy the newest collections. They seek the most fashionable models, whereby Czechs come and just buy clothes. So this is where we develop. We also develop our operation in the Middle East, Saudi Arabia, and another store which will be opened. And the stores will be also opened in other countries in the Middle East. And some milestones, the largest flagships, 3 floors, nearly 4,000 square meters. It's been opened in Stuttgart. This is a new thing for us. The stores at the commercial streets is a new thing for us because most of our stores are located in shopping centers, and now the flagship are located at the commercial street. So traditional stores. This is where we are really great at, and we feel really great at. But we also have online channel, which is developing very well. We've opened a new online store in Slovakia recently in October. Now let's have a look at our map. We have a new country. This is the new store in Saudi Arabia, and now Europe. There is no country in Europe that we would have less than 10 stores. So 10 stores in Germany, 10 in Hungary, 10 in Croatia, Germany and Croatia. These are the new markets that we added to our offer, and this is where we develop very fast. And now 121 stores within 1 year. This is a great success. 1 store every 3 days. So Monday, Tuesday, Wednesday, a store. Thursday, Friday, and Saturday, a store. So this is a very quick growth. Now let's move to the financial results. And the most important factor, LFL. so the stores that have been operating for more than 12 months, and the LFLs in local currencies dropped by 1.5%. But a positive thing is that the trend is growing. Each new quarter is getting better. What happened in the third quarter? Well, weather. Well, very hot August. So the customers, instead of visiting stores, they preferred to go to the sea or outside, spend time outside. And then September and again the weather, which contributed to lower sales. Now we are entering the fourth quarter, which is a very, as usual, it's a very good quarter for the sales, and record-setting December. Now the floor space. Let's start with geography and 20,000 square. The EU, 14,000 square meters of new floor space. So Czech Republic, Slovakia, and Germany. This is where we grew. We also have the growth in Russia and Ukraine, and we opened a new store in Ukraine, in the city center in Lviv. There was a new shopping mall opening, and we were able to open 4 new brands there. And again, Middle East, Saudi Arabia, 1 store. So looking at those graphs, you may ask what's happening to Poland. We can see that there is 11% growth in Poland. Well, I will answer that question with the second slide. In the middle here, we have Crop and House that recorded decreasing floor space. Well, those 2 brands open every summer, the so-called seasonal stores. These are tents offering our clothes that are located on the seaside. About 40 stores, 20 stores offered by Crop, and 20 stores offered by Crop, House and Crop. After summer, we close those stores, seasonal stores, hence we have the drop. But other brands are growing, 19,000 square meters in Reserved, and Sinsay also dynamic growth. So those 2 brands have been growing very dynamically in the third quarter. Sales revenues, 2% growth year on year. So slightly below our expectations because we would like it to be higher, but we have to remember that the weather changed our plans. So the situation was different than planned. But on the other hand, we also had the countries that contributed positively to our sales, the 2 new countries, Germany and Slovakia, and Romania, which is a very dynamically developing market for us. And Poland also contributed to our growth in sales in the third quarter. So growth in floor space and the sales per square meters. So the average sale per square meter changes, so the trend is continued in the third quarter. Online sales, e-commerce. Traditionally, you can see this seasonal changes of the third quarter where the online customers leave for holidays. Well, this is what was happening 2 years ago, a year ago. Hence, a lower online sale in the third quarter than as compared to other quarters. We are developing very dynamically in this area. We have opened online store in Slovakia, and by the end of the year, we are planning to open a store in Romania. Margins are under pressure of the US dollar. And I'm sure you've been observing US dollar rate, which is growing against zloty, and the next year will be no different. We will still be under pressure of the growing US dollar. And here we have also seasonal factors. July and August, these are seasons of sales. So September, we have collections that have better margins. up to 50%. This situation concerning the margins will be positively changing in the future. And the lower costs of own stores, record setting low level. As you can see, 91 zloty, the cost of space renting. We are opening bigger spaces, and we continue to negotiate the rent costs in Russia and Ukraine. Looking at the whole graph, third quarter of 2012 until third quarter of 2015, we have the drop minus 16%. This is really great work. The total cost now per square meter, and we have 15% drop year-on-year. Take a look at the graph on the right side. We have the cost of own and franchised stores, and they've dropped by 2% year-on-year. And this gray element at the top, these are logistics and headquarters costs, and they dropped 4% year-on-year. Where does it come from, this drop of cost? Well, observing the situation, then we have bigger stores that generate lower cost per meter. And we also change the franchised store into our own stores, and this is a cheaper solution. Smaller towns which had franchised Cropp and House stores, well, they open new shopping malls, and we enter the shopping malls with our own stores. So we terminate the franchise contracts, and we are able to offer the full cloth offer, and the cost of such stores is lower. Again, the 4% of drop of cost of headquarters, well, we lower the marketing budget. This is what we do in Poland, in Russia, and in other countries, but not in Germany. In Germany, we still have a 4 million euro budget for marketing spendings, because we want to actually support our sales. Now, the balance, 2% growth of sales, and our work on cost, which translated into 2% drop of cost. Our situation was that the cost was dropping and the sales were growing. The margin was lower, 106 million zloty, which was lower than as compared to the previous year. Net operating activity, it is better as compared to the previous year, mainly because of the FX gains. A year ago, it was 35 million zloty. So this is the better part of our operation. Other results are quite comparable. Operating cost, 267 million zloty. Also, the financial operating activity, the balance is better, and a good net result after 9 months. Now, the most important elements of our balance, inventories. Inventories are growing because the scale of our business is growing. You can see it on the graph illustrating individual quarters. The green line, this is inventories per square meter. It grew, this number grew to 1,684. This is a growth. But at the same time, US dollar grew by 20%. So from this perspective, we believe that our inventories remain on a very safe level and they are under control. And the next slide shows you the cash cycle. And the graph on the left side, you can see the growth of inventories, also liabilities and receivables. We have franchise stores in the Middle East. We also have. It is important that looking at the graph on the right side, well, the factors, cycle factors are cash cycle elements are safe. Our capex, the graph on the left, growth year on year, but observing the situation throughout several quarters, well, our expenditures are lower. Why lower? Because last year we've built the new logistical center, and this is where the most of the capex went to. And this year we had lower requirements in terms of the logistical center. Our work was completed, and we do not expect new cost that will be necessary for our logistical centers, and the capex will be devoted to our stores. And on the right side, you can see that our debt, the structure of our debt is changing. The long-term debt is growing because we want to be at a more comfortable situation. And we also have a small growth of a short-term debt. This short-term debt is a result of the growth of inventories, and this is illustrated on this cascading graph here. At the end of the quarter, pre-tax depreciation and cash flow. So this is the working capital. And capex, again, a big element. It's been funded by the short-term debt. On the right, you can see our cash flow for third quarter. A bit worse situation, a slightly negative result, but I'm very optimistic about the fourth quarter. I'm very optimistic about our cash flow and debts at the end of the year. And the balance sheet, which remains stable, the basic results for third quarter as compared to the previous year. Well, we have growth on each position. Our stores are growing, inventories, liabilities, receivables. We also fund our inventories, so hence the debt is growing. That's all concerning the financial part and the third quarter. And now I would like to give the floor to my colleague who will tell you more about our brands and something more interesting than just the numbers. Thank you. Yes, now you can rest for a few minutes after all those numbers, digits, and graphs. Now, a few words about our situation. At the beginning of the year, we started to introduce new stores, interior design. Now we are opening new design in Mohito stores. Some of you saw the new concept store during the Investor Day. By the end of the year, including tomorrow's opening, we will have 2 more openings. One of them will be important for you. At the end of the year, we will have an official opening of new Mohito store in Złote Tarasy in Warsaw. Well, our design, interior design, focuses on separating a special zone in the middle of the store, which brings the attention of our customer to special collections offered by Mohito. And most of the gentlemen that are here with us today, this is a very comfortable waiting room near the dressing rooms, mostly probably for the gentlemen who are accompanying our ladies, because we want to keep the customer in our store, and we want our customers to feel comfortable, and we also want those who accompany our customers to feel comfortable. The new market, the new brand in Pruszcz Gdański this year during the Investors' Day. Some of you saw our concept store. Those of you who haven't seen it, well, you will see it soon. The first quarter is coming. And concerning the new brand, well, the store will be open around March next year. Of course, in terms of openings by the end of the month, well, the situation may slightly change, but the 7 stores will be opened first. After the first store is opened, we will also launch online store. Well, our premises objectives concerning the sales, well, the average receipt would be 300 zloty, which is more than reserved, which is 50 zloty, and since a 30 zloty, so the average receipt here will be more. And capex per square meter will be 4,000 zloty. Our new brand will be dedicated to both female and male. In Germany, at the moment, we focus on developing the brand's image. We want to increase the awareness of the brand in Germany, and this is what we are doing in the 7 main cities in Germany. The first step has been already done in Stuttgart. In September, we opened the biggest store in our history, and another important fact is that we opened that store at the Commercial Street, which is important on German market. And the next year, we have already signed this contract to open Reserved stores in Munich and Hanover, also at Commercial Street. So we will have 3 stores opened. And of course, we are also looking at Berlin, Hamburg, and so on. So that this proportion between the number of stores opened in shopping malls as compared to the commercial streets, taking into considerations our plans for the next year, the 4 new stores, well, this gap will be decreasing. We will, at the end of 2016, we will have 10 Reserved stores in shopping malls and 6 at commercial streets. Our plans for marketing remain the same, and the next year will be just the same as this year, because we want to be visible in those cities, and we want to bring more customers to our store. Middle East. Now, let's move on to the Middle East. After 3 quarters, the results are very satisfactory, and we evaluate this market as very perspective, with great potential. We are also observing sales per square meter, which is nearly twice as big as the sale in Poland. In the 3rd quarter, we've opened a new Reserved store in Saudi Arabia. This is another 4th country in the Middle East. This is the most restrictive country in terms of store on how you present the clothes. I don't know whether you can see, but we can't really show the models with heads. We are not presenting any clothes that have any elements of human figures, also no military elements, so we have to be very cautious in terms of how we present our offer, our clothes. Well, the fact is that both female and male zones, these are two separate stores. So in terms of staff, well, we also have female and male staff. Women, there is no dressing room. They can try, for example, hat and so on. Ladies choose the clothes, they try it at home, and they come back to us if they want to replace it or so on. So this is how the situation looks like in Saudi Arabia. On the 14th of October 2015, we had new management board member, Mr. Sławomir Łoboda. He will be responsible for a very important field. He is the deputy president on leases. He is responsible for legal issues, new retail space and store development, new contracts. He's been connected with the company for many years, since 1997. He took part in the LPP stock exchange listing. He also took part in merger with Artman SA. Well, his position, his responsibilities are a result of the new split division of responsibilities in our company. This slide now, the title is Open Communication with Investors, and we hope that you can see it as that. We have prepared a booklet for you, for those of you who could not see us during the Investors' Day. In addition, during the Investors' Day, we've mentioned that the premiere of our new brand, so the official opening of the first store, will come with a presentation for the fashion circles in Warsaw. We would like to invite you in Warsaw for the premiere to our showroom. You'll see how our collection will be presented. Well, it will not be 100% of our collection, but most of it, so you'll be able to familiarize with it. We will try to pick a date that does not collide with any reports and any important events, but we'll be notifying you in due course. So that's all from me, and we are moving back on to numbers. Our plans for 2015. We don't really have much time left, and 2016. Speaking of this year, 2015, we maintain our target, 17% growth of year-on-year floor space. EU, 42% growth, Poland 12% growth, Russia and Ukraine 6% growth, and franchise in the Middle East. And we've opened new stores for the first time this year. So this is how the levels of floor space growth looks like this year. 45,000 square meters to be opened, half of it in Poland. In Germany, we will open 2 stores. Well, in practice, these stores have been opened at the end of October, so the plan has been completed. In Russia, we will open stores in 3 new towns there. We also have Hungary. This is the country where we try to accelerate our expansion. We have better trading conditions, better floor space renting conditions. And Croatia, Split, a beautiful seaside town. By the end of the year, we will open a set of our stores in the new shopping center. We will inform you how the trade looks like in Split in the summer when millions of tourists come to visit Split. And the expenditures, this number is about 500 million zloty, and stores, out of it, stores take 390 million zloty. And now the financial part. What's there? As you know, we don't really provide you with any prognosis estimates, but the general guidance is that the growth of sale between 5 and 10% this year, and we will probably reach a half of this number, somewhere between 5 and 10. Gross profit margin fall should be between 4 and 6 percentage point, and SG&A cost, they should be lower by more than 10% year on year. And we have the most important quarter ahead of us. This quarter can generate half of our revenues, yearly revenues, and I am awaiting the results. I believe the situation will be better. We will have better sale offs this year because we have less stocks to sell. No, and the costs, we can see a really big pressure on remunerations, wages, and the situation is similar across the whole region because we can see that the economies are developing. Hence, we will have to raise the wages in our stores and the headquarters. We will be observing, following the cost of growing wages. We will try to offset it with lower cost of floor space rentals, but we are not sure whether we are able to deliver that. So, and what else? Risks. Further fall in traffic in Poland. This is the competition in Poland, which is bigger. We can see the food markets that start to offer clothes as well. And our biggest competitor, Inditex, lower prices on products that do not allow us to grow, to increase our prices. And now macroeconomic situations in Russia and Ukraine, we are cautious here, but the situation at the moment is really good, and we hope it will continue to be as satisfying for us. What are our e-commerce long-term targets? We are not buying any external stores. We are not entering any platforms of other operators. We are developing organically. So we follow what our biggest competitors do. So they open their own stores, and we follow that strategy, and we launch online stores in all stores where we have brick-and-mortar stores. This year, as we have already said, we've launched an online store in Slovakia, and we will launch it in Romania. And next year, we will launch an online store in Hungary and a new brand premiere along with online stores. In 2016, we also plan to open online stores of other two brands where our online stores are already present, which is Czech Republic, Slovakia, and Romania. A very important slide, reserved targets for the next year. LFL's improvement, three elements of the strategy. So the growth of model and improvement of our collection and broadening our offer in order to bring new customers. And now more about each of those elements. Increased number of styles. We will have 50% pickup in number of styles. As compared to spring 2015, we will have 50% more styles in 2016, in spring 2016. Why we do it? We want to have enough inventory for German stores in order to have enough inventory in those 4,000 square meter stores. On the other hand, we can select our offer, our collections to fit the stores better. And the example, for example, our store in Arcadia sells the most expensive elements in our collections. So for a store like that, we will be able to offer them more styles, more models to sell. We will also have more expensive and less expensive styles. So smaller towns need less expensive, cheaper models. So this wide array of models, of styles, will help us to better fit our offer, so our offer fits better smaller and bigger cities, and we can offer better inventories and meet the demand of our customers. So more styles equals bigger inventories per square meter, so bigger selection for the customer. And the first attempts connected with higher inventory resulted with good outcomes, so we will continue that. Another element is quality improvement, and here I mean two elements. Firstly, we want to have bigger impact on the materials, fabrics that are selected, the resources that are used for our models, for our clothes. So we will tell our suppliers about the places where they should buy the fabrics. And on the other hand, we will have more impact on the production process. So we will have people visiting the factories, following and observing the process of production, manufacturing. Those suppliers who meet our requirements will start long-term contracts with us. At the moment, as you know, we work based on short contracts, short styles, but we will try to move on to more long-term cooperation and broadening target customer group. We will have new lines such as sports collection. We already have sports collections that are selling really fantastically. We will improve and broaden business line and broaden the fashion from catwalks, modern lines. So those elements will also be included in our offer. Another important element of our strategy is Germany. So far, we've observed in Germany that the German customer buys more than Polish customer, and when the German customer buys, he or she buys better quality clothes. So we will have to have more inventory in order to fit the demand of the German customer. We also need to work on our traffic, which is lower in Germany as compared to Polish stores. Hence, we want to apply marketing, promotion campaigns. We want our brand to be more recognized on this market. We want German customers to be more aware of our brand and therefore increase the sales. And now, moving on to Middle East, we are not talking about just Reserved brand. We will also add Mohito and Sinsay, which will enter this region. On the right, you can see the map with all the countries that we are present. And we will have Oman, Jordan, Bahrain, and United Arab Emirates, which will be added to this map. United Arab Emirates, we will open a new store next year. According to the contract that we signed with our franchise partner, we should have minimum 70 stores 70 stores opened within 6 years, 30 Reserved, 20 Mohito, 20 Sinsay. But we hope it will be better. This is the minimum. And as my colleague said, this is a region with a big potential. Sale per square meter is really good, and that is a good incentive for us to work on further development in this region. 2016 will continue our plans. So we plan 50% year-on-year floor space growth, which is more or less 125,000 square meters of new floor space. We are at the moment signing contracts for 15,000 square meters. We will be signing also new contracts next year. EU 24% growth, Poland, Russia, and Ukraine 8% growth each, and very dynamic growth and development in the Middle East. And once again, geography: Germany, Croatia, and Southern Europe, and also dynamic development in Romania. This is a very promising country. And of course, Russia, 10% of growth in terms of new floor space. This is the next year. So total cost will be 400 million zloty. 290 million zloty will be spent on the stores, so 20% less than this year. This is a good news that we spent less money on new stores, but this is the result of the fact that we will have more stores in the franchise model. In addition to the middle six, we will also have Belarus and Kazakhstan, which will be the countries where we will open new stores under a franchise model. We will have stores in 20 countries in 2016. In 2017, 2018, we want to continue this 15% growth pace. This is our strategy. These are our objectives in terms of growth in the future. That's all in terms of the presentation. Thank you for your attention, and now we are welcoming the questions. There are no questions. I can't believe that. There must be the first person who would start asking the questions. Are you planning any additional? The fourth quarter, do you plan to have any tax operations in terms of the brands? In the fourth quarter, we will have no operations of that sort. We are merging with our Cyprus company. It's been transferred onto the 2016 because of the procedural issues. I have the question concerning online sales. You have emphasized that this is a very important channel. However, in the third quarter, the pace has been slower. Do you expect that this pace will pick up again? Well, observing this new distribution channel, the online channel, we are observing new countries. We want to have online stores in all countries that we are present in. Well, the third quarter was not really good for comparison purposes. In the fourth quarter, we will see a quicker pace of growth. Well, this is slightly more than 1% of turnover. So what's the vision? Do you expect it to change, or maybe this will remain the same? Well, we can observe the situation on the market among our competitors. Online sales are growing dynamically. Well, in a long term, I can't really talk about a target situation, but when we look at US and UK, this is about 15% of share in the trade. In the long term, this may be the situation in Poland, 1%. Well, it should be a few percent in the future. Sales, how do you report it? How do you record it? When the clothes are picked up in the store, this is still online? Yes. Yes, it doesn't matter whether this is picked up at the store, collected at the store, or sent by post or courier. Well, it is still online sales. A very difficult question. Do you know what's the proportion is sent by mail and what part is sent by mail and which part is collected? I don't know the numbers, but I know that this is very popular in Poland. People decide to collect it at store because in the store because they can try it on and then check whether the clothes fit them. So this is a very popular solution in Poland. And how much the cost of wages of the human resources, how much they can grow? We are still calculating how that impacts, how that influences our next year budget, but it will be several percent of growth. Of course, I mean here the cost connected with the human resources. Could you tell us more about inventories after the third quarter? What are your expectations in terms of the fourth quarter? Is it a result of the sales that was as it was, or maybe this is just an estimation for the next year? Well, this is not a consequence of any problems. This is our standard activity. So the inventories at the end of September equals inventories of a new collection for the next quarter. So in terms of quantities, it's similar to the previous year, but because the US dollar is now more expensive, is higher than the next year, than the previous year, well, it's in terms of money, it's more, but we are at a very safe level. Do you plan any growth of prices in terms of average ticket next year connected with this US dollar appreciation? I will talk about margin and whether we can actually expect any pickup in the margins next year. Well, we now think that it may be very difficult. We plan that our margins will be similar to the previous year. First of all, the US dollar rate. US dollar has reached nearly 4 zloty. Well, it affects our margins. And on the other hand, we need to remember about our competitors. Our competitors are very active, especially on the Polish market, so we can't really increase our prices. So since our competitors don't do it, we can't do it. And also, even in Ukraine, when we were increasing the prices this year very significantly, well, next year we are not planning any increases next year. Another element, the third element, are the purchases, the cost of purchases in China and India. On the one hand, we have depreciation of yuan, which contributes to better conditions, purchasing conditions. But on the other hand, we are working on improving our quality, so we are investing in better quality. And the last element, we sell to the Arabic countries, to our franchise partner, and our margin here is lower than the margin that we have in our own stores. So our margin will be slightly lower, but this sale does not come with any cost. So the gross margin of sales to our franchise partner will translate to the same operating margin on the level of the operating profit. And now I would like to learn more about the procedural issues. Well, these are procedural issues because the legal process has been extended in Cyprus. So we wanted to actually continue our operation in a peaceful environment. Hence, we moved it on to 2016. Now we have to focus on the fourth quarter. So we've decided to move it to the first quarter, first half a year of 2016. I have a question concerning LFL and one of the drivers for the growth of in this year, so the growth of inventories in the stores. Historically, it was 1,500 zloty per square meter, which was the target. Why do we see any nominal growth here? This target that I've mentioned during the previous conferences, this 1,500 zloty per square meter was previously applied when the US dollar against Polish zloty was about three something zloty. So we have the growth from 1,500 to 1,800 zloty and no changes to items number. So this target, 1,500 target, will be changed. I don't know what the amount will be exactly, but because of the US dollar situation, it will be higher. Well, you will have more inventory per square meter. Yes, well, yes, but I don't think it will be a significant growth. Well, you can't really count on any pickup in margins. US dollar and competitors are two elements. As I remember, everyone buys in US dollars. And then now we have competitors, so we can't really offset this and move the cost onto the customer. Why is that? So is the market changing? Well, the competition is bigger than it was before. We have more stores, more shopping malls. We have smaller companies that enter the market. We have new foreign players that enter the market. And in the past years, well, if the dollar was growing, we could actually translate it into the prices of the items. Now we would like to have this opportunity, but judging after 2015 and the operations activities of our competitors, we can't do it first. They don't do it. We need to actually compare our products and our prices to our competitors. And the next year, the margins will remain on the similar level. You're asking whether the margins can be even lower because of the competitors. Well, with this objective, you believe that the situation will remain the same, but we can see that the competitors are growing. The competition is growing. So how will you be able to maintain those margins? This is very optimistic scenario. Well, we will invest in new products, in new styles, new base, new lines. We are talking about better quality products and wider offer. And this is our answer, and we hope that this will help us to maintain our position on the market or improve it. Will this larger number of models influence the logistics cost? Well, it shouldn't. From the point of view of the logistics, it shouldn't really be important. Of course, the volume will be growing, and with the growing volume, we will have higher logistic costs, but per one unit, the cost of logistic is dropping. So we are not really afraid of the logistics cost. Are you sure that if you increase the product offer, well, you will have more returns from the customers? Well, having decided to increase our product offer, well, we risk that the customer's behavior may change, but the most important factor here is our sale. If the sale starts, well, all the other elements, the returns and behavior, these are smaller problems, and we've been able to manage them for several years already. I have two questions. Could you comment on LFLs and margins during the first days of November? And I would like to ask about inventories in the next year. What objectives concerning LFL sales you took into account when you were making orders for the next year? Well, the first question, I can't answer that. We need to wait for November to end. What's the situation at the beginning of the month may change at the end. For example, I don't really want to comment on that in the mid of November. We don't want to speculate. The second question, what were our objectives for the plans for 2016? We were planning that the growth would be positive, a few percent positive. It turns out that there are no other questions. Thank you for your attention, and thank you for your time, and I hope we'll see each other during future conferences. Thank you so much.